Good morning, everybody. It's Wednesday, September 18th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, December corn up 3/4 at 413 1/4. November soybeans are up 10 1/4 at 1016 1/4. And December Chicago wheat was up 3.5 at 579 1/4. No export sales announcements here this morning. Pretty quiet on the news front. We did, however, gentlemen, have a question overnight from our YouTube kingdom. So if China continues to be flush with grains and Biden continues the trade war by eliminating the import taxes for consumers, should the farmer plant maximum crops next year or consider a substantial cutback? I know we talked about this a little bit here before the show. Dustin, maybe share a few thoughts. I know you had some anecdotal things to talk about relative to prevent plant acres and how that affects our overall makeup. And then we'll throw it around the room.
Yeah, thanks, Dan. Yeah, it's definitely very hard to get production cuts from acres sitting fallow. Price incentives certainly have an impact on that. When we look at years like, let's say 2020, where we have a major sell-off in price prior to the planting window, we did see an uptick in prevent plant acres. That year we were at 10.2 million. Normally we get anywhere from 1 to 6. We know 2019, obviously we had 19 million. That was from an actual weather event. But 2020, I would argue that a portion of those 10 million acres was from a complete lack of financial incentive to plant at that time. And you could argue like we still have to have an event to justify prevent plant acres. So I think every year we're going to have adverse weather, especially in some of these fringe areas like the Northern Plains. But if you're at $6 corn, there's a lot more incentive to mud it in than if you're at, sub $4 corn at this type of cost structure. So that's my opinion. I think the market has some leeway, but otherwise, we really shouldn't expect that there's going to be a, Iowa, Illinois ground at all that sits, that maybe some will, have a bigger incentive to go into CRP sooner, but that's just not going to be material at all. So my guess is that to get a true production cut globally, we need to really put some red on the board. I would argue that we're seeing that this year and next year right now with the projected losses in 23, 24, and 25. That's 3 years of projected losses for the average grower. And I think I heard this comment, from somebody like a week or two ago. It's like, well, at some point I can make money growing corn at 350. I had been able to do that in the past, and I will be able to do that again in the future. And I would say that that's going to be a hard task. A lot of the cost of production, that supply chain is based on, labor. I mean, seed, equipment. Ag is a fairly small portion of the economy. Labor is something that's very hard to go backwards on for cost structure. And so I would think trendline yields, if we continue to see major trendline yield increases, that offsets some of that. But otherwise, you're going to find some sort of equilibrium, like we have in the past. We for a long time we had corn in the 2s, and that was kind of, couldn't really go below 2. And then for a while, last decade or decade and a half, we really had a hard time going below 3. We set that benchmark low in the financial crisis for corn. It was like 290 back on like December 5th, 2008. And we really haven't tested that since. I would argue that with the way the money supply has gone and how you're seeing other hard assets like gold, way above its long-term averages, new record highs. Part of that is actual inflation, and that the benchmark price of corn may be set higher than it has been in the last 2 decades. And that's what's going to be needed. It's really not the cost of production coming down. It's actually the output needs to stabilize, and a little bit of a combination of both. But I still think the output is probably the one that needs to stabilize and go higher.
And that's nervous because that's out of everybody's control, right? We think that we can tangibly control, the input side and get better deals or trim corners here and there. But looking at futures prices, they're going to do what they're going to do, right? And that's kind of an uneasy feeling for people that say, well, okay, well, maybe it has to stabilize. Well, maybe it doesn't, right?
Yeah, right. Yeah. I mean, in the 80s, we had double digit, bankruptcies. I mean, I hope that we don't have to go into that type of a pain to get cost structures down and that it is the output. I'd rather see the output just to rise to some sort of equilibrium that makes sense for everybody, all parties. We have these cycles though, right? We go down, the pendulum goes down for a number of years and there's a pain point. And I think the goal of those years is to survive through them relatively unscathed compared to everybody else, and then be there again for the good times because they will eventually come. And maybe we go right into a South American drought this winter, and like the pain is over at that point, right? Because global production suffers enough that we're back into kind of a deficit globally. We're one bad crop year away from that happening, so I don't want to just say, oh, we're going to be in this perpetual bear market forever. But right now, all things hold true. If we have another trendline yield in South America and trendline yield, record yield that we're talking about here, yes, we do look pretty flush right now, and there's more pain to come potentially in the next year. So I don't want to just say don't hedge, but I still think that your flat price, everyone is looking at a long-term chart of corn and pointing to it and saying, oh, here's where we could go. And that long-term chart of corn is still using a dollar index that's been severely beaten up from the fiscal policies of the last 5 years.
It was interesting. I was with one of our growers in Northwest Illinois yesterday, and he had made mention that, you go to these, first of all, there are a lot of land moving right now, and, prices to this point have been stable in the land side. I mean, you've had stories of some, sealed bids, which kind of talk about, they give them the option for, not disclosing what the final price is. And, so there's things like that going on, certainly. But his point is that there is still a lot of institutional money that's showing up at every single one of these auctions. So they still have an appetite for farm ground as a diversification for their total portfolios.
Yeah, the M2 supply has just skyrocketed. I mean, we forget during COVID, we printed, 25% of all dollars, ever created again. We have expanding deficits that we can't get under control. At some point, like we've been so spoiled for the last 30 years from a stable currency that I still think that, today is FOMC decision day. Is it going to be a quarter cut or half cut? We can't take any sort of normalized rate without the entire financial market screaming that that's too much. It's a burden for the current debt situation, both public and private. So the only way out, and I think that this is the path that people will take, like Senator Warren this morning is saying, the Fed should be cutting 3/4, not 50. Like it's a sign of the fact that we can't take any pain in financial markets. And so they immediately want to go push that pain off into a devalued currency. It's that hidden tax. In this business, thankfully, where it's an export business that's dollar denominated. So we should continue to rise and fall with that, with that falling currency, just like South American growers have probably fared out better than a lot of other market participants that are not in export markets down there over the last 20 years. I think the same thing could be the case for this industry. It's a good industry to be in if that's the case that we're going down. But that's why I don't want to take a big bet on the output, and the people asking about selling D25 corn and even D26 corn. It's like I'm all for hedging, but if you go take that bet by selling that forward and not having your inputs locked in, I think there's a risk in that in itself too. Because if you see prices rise for corn, I do think fertilizer prices are capable of rising from where they are today. So, the dollar index is going to have, I think, a bigger and bigger impact on how we do business in the next couple of years as we come out of this, this hiking cycle into a cutting cycle.
Ben, what's on your mind this morning, buddy? You're muted. He's got a lot of good things to say, but he's muted. There we go.
Yeah, I'm just going to jump on a little bit for what Dustin said about us being a nation that doesn't want to take any pain. And unfortunately, we haven't really had, the last time that we went through this was the '08 housing crisis, and we took all the pain in one shot, and it becomes severe. And I think that that's what we continue to set ourselves up with as we refuse to just take a little bit of, a little bit of the harshness that comes with the things that we're doing. And, we could be setting up for some really volatile markets in the next quarter, next 2 or 3 quarters, because of that. And, kind of on my radar that I am, as a citizen, I get frustrated that we're not willing to take a little bit of pain. I think the last real shallow recession that we had was the early 90s, right? Where we just kind of had to bite the bullet for a little while. So you get really concerned when it becomes a political lever to pacify the masses at the long-term expense. And, I think that's problematic. I also think that when we look at the corn balance sheet in particular, maybe we are going through this cycle of what it feels like to be the residual world supplier. But at the same time, we've raised corn yield pretty consistently last few reports, and our carryout projections have gone down. So we're priced and we're doing business and people are using cheap corn. So I think that a little bit more scrutiny is going to be put on where do we go with the safrinha crop, where do we go with the U.S. crop, and certainly where are we headed as South America starts to enter their planting season. So from these prices, the end user can sit on their hands. That's their, carries. They let it come to them. And what do we have to do to jog them loose to where all of a sudden they've got to put their hands on reasonable supply to lock in their margins? Right now, if you use corn for anything, you're doing okay. If you use soybeans for anything, crush margins are good. So, maybe this plays out for a little bit longer, but I do think that at these prices and the demand that we're seeing from corn in particular, there's going to be a lot more scrutiny on any sort of supply disruptions.
Ben, what I know there's some key numbers that we're kind of going to start bumping up into here, certainly in corn and beans. What kind of areas you got your eyes on?
I mentioned last week that the first barrier on the market profile is getting above 22. We stopped there last night.
What market are you referencing?
I'm referencing soybeans right now. Okay. And we did get above the 50-day last night. If anyone who's as a lunatic as I am and you were watching that at 9 o'clock, we saw a bunch of buying when we got above the 50-day and beans in the overnight, shot them up. That comes in around 10-14. The next major moving average is 100-day, which comes in around 1090. That would be a breath of fresh air. I'm a little bit concerned about the calendar in large crops with an unhedged grower. If we can see that, there's a lot of things at play here with interest rates moving. Maybe people are getting tired of the short grain trade. They've made a lot of money on it. And then in corn, we fought around that 50-day. We spent multiple days trading above and below it. We're above it now. And the 100-day comes in around 434. And I would expect that from 425 to 434, if we were able to get to those levels, we would see a tremendous amount of producer selling. Kind of looking at, we talk about bear markets. This feels good right now. We had a rally like this last year, almost the exact same time. Bear markets can have 10% rallies, not negate anything that's really going on. 10% rally off our lows takes us to 423 and a half, right below the highs that we struck previously on a bounce. So I think there's a lot of moving parts here in corn. And, with being above the 50-day in corn and soybeans, I think you start to make the longer term short a little bit more nervous about their position.
Very good. We're going to be coming into the open here. Rylan, strong day yesterday in the cattle markets, and I know we've got some cattle on feed estimates that are starting to float around. So why don't you give us a quick rundown here this morning?
Yeah, really good action yesterday. You had a lot of new buying, I think, just in the meats in general, new highs for the move and some of the back months and hogs here. So it seems like you're getting that optimism, especially in the deferred contracts. So we had a big increase in open interest in both places. So just looked like, especially in the cattle market, looked like there may have been a little bit of cash trade early. I think that's what got the market whooped up, but still kind of unconfirmed at this point. So we'll see if what that comes out to be. But overall, it seemed like that's what really was kind of getting everything moving. So a nice little increase in open interest. So it looks like we got a little bit more optimism to start. But yes, the cattle on feed report is looming. We got placements, or excuse me, on feed, SEP1 expected at 100.8%, August placements at 98.9%. And August marketing's at 96.6%. So a little bit down in placements may make the buyers a little bit more comfortable down here, although it's always seems like we stay on the cautious side right before the report. So the focus is really going to be on cash, maybe on the export market, and really on the beef. The beef has been kind of lagging a little bit of this news here. We just kind of mixed yesterday. So keeping an eye on that. But overall, it seems like maybe cash market could heat up again. We did see OKC auction, at least on the report from the 16th, was up pretty substantially, 3 to 8 in feeder heifers and steers. So I mean, overall, just seems like we're finding some real cash support. And on the hog side of things, same thing. It feels like cash market just found a little bit of support yesterday, up 37 cents at 77.33. So yeah, I mean, it just looks like you get a little bit of optimism. Still want to be cautious here, just because we're starting to hit. We pretty much took back all last week's break in the hog market. So just something to keep an eye on. And we'll be watching for that cattle on feed report. And on the hog side, it looks like we're going to be looking for the export report tomorrow. Maybe give us some indication that maybe demand's picking up.
Beautiful. Appreciate the rundown. Brady, thank you for tuning in this morning. We appreciate the nice comments from our friends over there at ATI. Just came into the open here. Get a quick rundown of the markets. December corn's down a penny at 4.11.5. November soybeans are up 11 at 10.16 3/4 is the last. And December Chicago wheat is up a quarter at 5.76. Tomorrow morning, as Rylan mentioned, we will have weekly export sales. That'll be out at 7:30 Central. One thing to note today, the Fed announcement will be out at 1 o'clock Central. We'll certainly digest that information. We'll talk about it in our afternoon and evening commentaries. And I'm sure it will be a topic of discussion tomorrow morning on the War Room as well. We appreciate everybody on a daily basis tuning into the show, like our friends at ATI and other industry partners that we've got. If you like the show as much as we like putting it on, give us a like or subscribe. Certainly helps us out, and we'll keep you up to speed on everything relative to AgYield there. So thanks again to all those that tune in on a daily basis. We are doing this every day that the markets are open, live streaming on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good conversation. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
Thank you.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.